Recently, it seems that whenever people hear about the Chinese government intervening in the market, there's an immediate anxiety, as if hyperinflation is on the horizon. In the past 2 years, any minor stimulus effort in China has triggered this periodic inflation phobia in the market, causing investor concerns. Particularly now, as the Ministry of Finance plans to issue a 6 trillion yuan debt restructuring package, and the central bank accelerates its monetary easing, there's a worry that money will flood the market, leading to rapid price hikes and potentially triggering overall inflation. Welcome to another look at finance, where we bring you an in-depth look at social and economic trends in China to help you make informed decisions in a dynamic economic environment. Be sure to subscribe for more. Today, we'll explore the current economic policies and market phenomena from multiple perspectives to examine whether these policies will spark inflation or, conversely, extend the period of deflation. Will monetary easing really bring hyperinflation? Let's start with the first question: does this monetary easing mean what many believe it to be? To understand this, we need a deeper look into easing. Many people assume that a central bank lowering rates or government issuing debt equates to monetary easing, but it's essential to assess whether this money actually flows into the real economy and genuinely generates liquidity. We can use M2 data to understand growth in the overall money supply. Indeed, the central bank's data shows that since the second half of 2023, M2 growth has slowed, with a marked moderation in monetary expansion since early 2024. What's behind this trend? Money is primarily created through loans. If companies and individuals lack the motivation to borrow or take on debt, the banking system won't generate significant amounts of new money. Since late 2020, loan growth in China has been declining, with the downtrend accelerating into 2024. This drop is largely due to economic sluggishness and low investment returns, which reduce the demand for borrowing and subsequently shrink the money supply at its source, directly affecting liquidity. So, those who view the central bank's moves like MLFs or reverse repos as all-out monetary easing might misunderstand. In reality, the central bank is merely maintaining financial stability, with much of this money failing to reach the real economy. Monetary easing does not equate to credit easing. This illustrates China's current loose money, tight credit scenario. While the central bank has attempted to ease monetary conditions, banks have not extended loans widely to businesses and individuals. Consequently, money in the market has not flowed significantly into sectors like consumption or real estate, avoiding inflationary pressure. Does local debt restructuring signal a major easing? Many believe that debt restructuring is equivalent to borrowing or issuing new debt, inevitably bringing new liquidity and thereby inflation. However, the reality is different. This year, China faces a market in a state of asset scarcity, with substantial funds struggling to find suitable investment avenues. Many investors are even rushing to buy government bonds. Local governments raising funds through bond issuance to restructure debt is essentially reallocating existing funds within society. If an ordinary investor purchases a local government bond, their money simply transfers from their bank account to the local government rather than being printed out of thin air. Thus, local debt restructuring does not actually increase the total money supply in the market, but instead reallocates existing funds to address debt issues, meaning it does not add inflationary pressure. Against the backdrop of asset scarcity, local debt restructuring essentially creates a debt redistribution effect. This debt is not new, it's simply redistributed within the pool of societal funds. While this restructuring alleviates local debt issues, it does not directly affect the money supply. Now, let's consider the main policy stance: de-risking and steady investment. China's economic policy leans toward deleveraging, which limits the extent of monetary easing while ensuring overall low leverage and stable operations in the economy. At the same time, the government has been investing substantially in infrastructure and manufacturing, maintaining a stable growth rate. The result is that the scale of monetary easing does not generate inflationary consumption, but rather largely funds industrial and infrastructure sectors, ultimately translating into inexpensive industrial products rather than consumer goods. This pattern is unlikely to trigger widespread inflation and may even deepen deflation. In particular, fixed asset investment growth remains high in multiple areas under policy support and fiscal subsidies. For instance, the mining sector saw a 15% growth rate, manufacturing 9%, and telecommunications electronics manufacturing even achieved a 14% growth rate. Such investments are directed at industrial production rather than consumer areas, thus having limited impact on overall inflation. Where is the current deflationary pressure coming from? Certain market phenomena reflect this. For example, there's an intense price war in the electric vehicle industry, while sectors like steel and photovoltaics have issued notices to curb excessive competition. This trend reveals a unique characteristic of China's current economy. Prices for industrial goods are falling, while prices for essentials like utilities and food are rising. This trend is also reflected in the GDP deflator, which has generally been negative over the past 2 years, indicating an overall price level that hasn't risen and has shown slight deflationary pressure. Morgan Stanley's report outlines 3 economic models and their inflationary effects. First, investment-driven model. In this model, the government prioritizes investment to maintain GDP growth, leading to low inflation, likely between -0.5% and -1%. Second, de-risking model. Under this approach, economic growth moderates, investment declines slightly, and inflation rises slightly but remains low, with the GDP deflator below -0.5%. Third, consumption-driven model. If economic development shifts from an investment to a consumption orientation, inflation gradually rebounds to a moderate 2 to 3% level. Since 2024, China's economic policy has oscillated among these models but remains predominantly investment-driven, with GDP growth supported primarily by investment, which likely prolongs the deflationary trend. In summary, the policy direction remains unchanged, and deflation will likely persist for some time. Historically, prolonged deflation is unfavorable for economic development. However, China is choosing to promote growth through infrastructure and technological investment within a low-risk, low-leverage environment which effectively prevents excessive market inflation. For the general public, this environment means limited price hikes in consumer goods, while industrial goods prices will continue to compress. For investors, asset allocation amid this low inflation environment is a critical question. Here are some recommendations. First, hold cash and high liquidity assets. Given the relatively loose monetary environment but limited actual liquidity, holding cash or highly liquid assets is prudent to cope with potential short-term fluctuations. Second, focus on policy-driven investment opportunities. Short-term investments can target areas of temporary government expansion, such as infrastructure and high-tech manufacturing, but investors should stay flexible and adjust accordingly. Third, exercise caution with long-term real estate investments. Current policies on real estate are inconsistent, and overall demand is low, increasing the risk of long-term investment in this sector. Fourth, explore short-term opportunities in industrial goods. In light of declining prices for industrial goods, short-term investments in industries like electric vehicles and steel amid price wars may be worthwhile. In conclusion, China may enter a prolonged period of low interest, low inflation environment over the next few years. Current policies will not result in hyperinflation, but instead maintain price levels in long-term stability. It's time to subscribe to our channel, as we will continue to provide deep insights into China's economic trends and market changes to help you remain calm, rational, and make wise decisions in this complex environment. Let me know if there are any sections you'd like refined further.